Maverick of Wall Street, he's the top subject of today's video. We're going to talk about his, looks like a potential ban on YouTube. I want to speak about that for a moment as a fellow YouTuber. Then we're going to go ahead and react to a bunch of different videos here, okay? HUD CPI data was a wake-up call to people who got carried away, says Mohamed El-Erian. So looking forward to getting to that one, sharing my opinions and perspectives. Then we'll get into Gene Munster, says AI could power the NASDAQ 2 times higher in the next 2 to 3 years. React to that one. Then Dan Niles, Dan Niles, we definitely see eye to eye on Meta stock. So we'll hear what Dan Niles has to say about Meta here. And then last one up here, everybody's favorite bull, Tom Lee, went on CNBC yesterday and spoke about AI, spoke about his views on the market, all those sorts of things. So appreciate y'all joining me as always. Thanks so much. All I ask in return, smash a like. Make sure you subscribe to the channel. That's it, folks. Smash a like. Make sure you subscribe to the channel. I appreciate you. If you want to follow me on X, that will be the pinned comment down there. I feel like a lot of you guys probably don't even follow me on X. I don't think a lot of people even know I post on X or, anything like that. So anyways, if you want to follow me on there, that'll be pinned comment down there today. So let me just talk about this Maverick situation. Late last night, right before I went to bed, I actually saw this. Maverick of Wall Street memberships are paused. As soon as I saw that, I said, uh-oh. Something happened. He got in trouble. It said, "Hi, Jeremy. The channel membership feature on Maverick of Wall Street has been paused, so your membership has been paused, blah, blah, blah." So, and I've been a supporter of him pretty much since he came out with his membership. And I'm like the highest tier, like the $99 a month tier or whatever. And I like supporting people that I watch their content pretty regularly. And that's in many different spaces, but obviously in the finance space. And so I've always been a supporter of him for, I don't even know how long he's had that program, maybe a year, maybe longer than a year. And, I always enjoy his content. You may say, why would I watch somebody like Maverick of Wall Street? So bearish always, obviously. He leans insanely bearish, right? Usually tells you why the world's going to end and this and that, in terms of the market crashes and those sorts of things. The reason I love Maverick and the reason I watch him personally is because I've been in the market 15 plus years now, right? I have millions of dollars invested and I lean very optimistic. I lean very bullish, right? I'm always thinking about how companies are going to grow, how economies are going to grow. So I like just having somebody out there who's going to tell me why it's all going to go bad, okay? And so that's why I appreciate his channel, personally. Is it the best channel for if you're somebody in your first few years of investing? I'm not so convinced about that. You might get started in the wrong direction, but for somebody that's experienced with a lot of money in the market that wants to hear a different perspective, maybe that leans definitely bearish. Obviously, if you've ever watched Maverick, you know that man leans bearish, right? Much more of a pessimist than an optimist. I love it. I love watching that content, and I love, kind of just hearing, that way it just kind of keeps me balanced from getting too over euphoric and those sorts of things. Because if there's one thing I know with myself, I can get too euphoric, right? So this was what Maverick posted here. It says, "Dear Maverick members, as you might be aware, YouTube decided to take action against the channel, which will prevent monetization and uploading new videos. When I began this channel, the goal was to share my experience, commentary about the financial markets. The channel grew beyond imagination, and we created a community that I'm very proud of. Nothing made me more happier than the feedback," those sorts of things. "I'm known to have strong opinions, and I'm not shy to express them. I grew up in a world where freedom of speech and expressions was not allowed. This is why I cherish and never shy away from expressing my opinion publicly. Malice was never my intention behind my opinions or criticism of others." So I think it was last night I was watching his latest video. And I was watching on the treadmill, actually. And I believe he said something. I don't really want to even comment on exactly what he said because I also don't know if I 100% remember the exact wording, and I don't want to put words in his mouth. But it was something that the moment I heard that, I was like, oh, that was a little bit. But I didn't think anything of it because the thing is, this was a private video he put out, but he uses YouTube as a platform to put it there. And so my thought was, well, YouTube's not even going to ever watch this, but apparently YouTube must be paying attention to his private videos he puts out as well. So, anyways, my guess is the specific comment he made last night that I'm not going to say what it was because once again, I don't want to. If I remember incorrectly and then I say he said this, I feel bad that I said that. But there was one thing he said that definitely I was like, ooh, and so I would bet YouTube saw that and probably was like, okay, that's enough. And I think he had been in trouble before. So, that's that situation. And I hope he comes back, and I hope, everything gets worked out there, because like I said, as somebody that leans optimistic, leans bullish, I love hearing a bearish perspective out there. So anyways, alrighty guys, so that's that situation. Alrighty, let's react to these videos up here.
Let's want to bring in Mohamed El-Erian, who, of course, is Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University. Mohamed, how much tougher is it going to be for the Fed to cut rates at this point?
I think it's going to be as tough as it indicated earlier. We're not going to get more than 3 cuts this year, and we're probably not going to start this cutting cycle until June. The market had gotten carried away. And yesterday, a relatively small miss in numbers that are very sensitive to seasonal adjustment created this outside size reaction. And it just shows you the extent to which the market had gotten carried away without much critical thinking about a very soft landing, many cuts, starting early. This was, I think, just a wake-up call to people who got carried away.
The very important thing about this whole situation, in that CPI yesterday, the very important thing is what just happened. Well, March is done. Like there were still some people that were like, maybe in March they start cutting. That's out the window now. After the CPI number, now the thought process goes to May. Maybe May they start cutting, right? And as I tell you guys, I'm not in a rush for them to cut. Usually when the Fed starts cutting, it's usually not usually great things for the market moving forward after that. So I'm in no rush for them to cut, but it is coming, and it looks much more probable that it's going to be May. And March is, I would call it, a little bit more of a far-fetched dream at this point in time in terms of the Fed cutting in March.
We did see markets kind of quake, at least in the instant reaction to it. Yields moved pretty significantly higher. You saw equities sell off, but you're still talking about the S&P 500 and the Dow down by less than 2% from their all-time highs. And as Joe was pointing out earlier, that may be a reflection of how strong earnings have been relative to expectations, too. So is there a way for the market to continue to climb even if the Fed does not cut rates?
Yes, there is a way, and it has to do with the strong economy. It has to do with earnings, and it has to do with the extent to which the U.S. is exceptional relative to other parts of the world. This is more an issue for the fixed income market than it is for the equity market. And the fixed income market has to realize 3 things, Becky. One is service disinflation is really hard. We're not going to get it as quickly as we need to get to 2% as fast as the Fed wants to get to. 2 is that there are genuine analytical questions about what is the neutral interest rates? What's the right inflation target? How fast should you get there? These are serious analytical questions. And then the third element is that different parts of the economy differ in how sensitive they are to interest rates. And the market has to realize, the fixed income market has to realize these 3 things. And I think they got it. They got the message yesterday, but they overreacted because they hadn't thought about it enough beforehand.
This is the scary way that recessions come about, isn't it, Mohamed? And I'm not saying there's any similarity to the Volcker era or anything, but to finally get it under control back then, and it's not similar, I know that, but you had to cause a recession to get it under. So it's almost like the rates didn't go up enough. This is a strong economy, as you say, relative to the rest of the world, but they may need to do more work in terms of slowing that. They may have to basically cause the slowdown to get inflation where, and that's, maybe a recession would never happen if it wasn't actually caused by central bankers trying to cool inflation.
I mean, that's the risk, Joe, clearly. But to be fair, and I've been very critical of the Fed, they started late, they made all sorts of forecasting mistakes. But to be fair to them, they've done what they need to do. The problem is the marketplace. The marketplace embraced last November, December, a totally unrealistic path for Fed cuts. Remember,
they told us so, Mohamed. They let the market believe that with their stupid dot plots, right?
Although their language was very different than the dot plots.
Yeah, the dot plots told us 3 cuts. The market, for some reason, embraced 6 to 7. But where they failed, and I agree with you, is on communication. That communication has flip-flopped. It's been poor. But this is not a Fed issue. This is a marketplace that got carried away and is now adjusting. And the risk is, as you point out, that the marketplace adjustment may pull the rug from underneath what is an exceptionally strong economy and one we should be proud of.
Well,
so let me push back against Mohamed here for a minute. Is the market even adjusting, right? Is the market even adjusting? Let's pull up stocks here today, and let's see if the market's really even adjusting anything. We had one down day yesterday, right? Let me look at my stocks. Overwhelmingly, definitely green today, including, look at Fubo, 6% move, Planet 4%, Revolve 4%, Palantir 4%, SoFi 3%, Shopify about 3%, Baba's up. Oh, Baba. Meta's up very nicely, 2% move. Mattel, Nordstrom, Tesla, Amazon, Wynn, Nike, PayPal, all green. And the worst stock is like negative 1.7%. Let's pull a big tech watch list here. That looks like a lot of green to me out here, right? Oobity booba stock. Wow, big move for Uber today. Congrats, Uber shareholders. 12% move. Netflix up. AMD up. Shopify up. Salesforce having a great day. Snowflake. I mean, the big dog Apple's having a bad one, but outside of that, it's a lot of green out there. So I'm just not so sure about this the market's readjusting because it had one day, right?
Trying to figure out is there were a lot of sectors and a lot of people that were counting on these rate cuts to refinance, whether that be in commercial real estate, whether that be in other projects that are totally sensitive to interest rate issues and things, that either need to be refinanced or you're going to lose. Those are the people who were really praying and counting on these Fed cuts coming sooner. If it doesn't come till June, is that the sort of thing that causes a recession when all of a sudden you have a lot of bad loans that can't get redone?
Listen, holy smokers, this is no jokers. Okay, listen. The Fed, everybody that thought maybe the Fed's going to cut in March or April, right? 25 basis points. 25 basis points is not going to move a recession or not. If there was going to be a recession with a 25 basis point cut or keeping it 25 basis points higher, there was going to be one regardless. That had nothing to do with it. You need to move interest rates several hundred basis points to really get it to affect the economy in a substantial way. Okay, that's the bottom line with that 25 basis points. Are you kidding me? Literally, that's literally like nothing, like 25 basis points. So if recession hits, it was coming no matter what, whether they lowered interest rates 25 basis points or not.
Extent, or is that just going to be a situation where some people are losers and others step in and get really good deals as a result?
I think it's going to be the latter. I think we have a stock problem. Undoubtedly, Becky, we have a stock problem. We have a whole host of activities that were funded at artificially low interest rates and that are today unrealistic at the valuation that the owners think they should get. And that's going to be an adjustment. And you see it in commercial real estate. That's the leading example, but there are other sectors as well. So it's a stock issue. But the good news is that there's lots of money on the sideline waiting to engage at lower valuations. So we can manage through this as long as it is not too disorderly. I don't think in itself this is high recession risk. Where you get to a uncomfortable recession risk is when you combine the stock problem with the fact that the household buffers, this excess savings they had developed, were drawn down last year, and then add on top of that a global economy that is slowing down significantly. That is where the recession risk comes in, but I think it's less than 50%.
Wow.
If you hear things like we've heard the last
recession risk
couple
less than 50%, that's a pretty big statement there, right? And the thing that everybody needs to factor in that I don't think enough people are factoring in, that I think is very important in this whole story, is real wages. Real wages were going down for several years and then kind of flatlined. Just very recently, real wages have started to tick up again, which is very, very helpful to a lot of folks out there that have been, let's call it in the brackets of kind of struggling because of inflation slicing and dicing them and their wages not keeping up. Finally, inflation has started to chill out, as we all know, right? Really over the last 6 months. And meanwhile, real wages are starting to tick up in a good place. And so that's something I think a lot of people need to factor in that we just didn't have working for us for several years, to be honest.
Is Airbnb and Expedia both saying that consumers are slowing down? They're not back into this revenge travel like they used to be. Growth rates are getting back to normal levels. Will growth rates at normal levels in all areas of consumer activity be enough to continue to propel the market?
It should be. I mean, we were at remarkable growth levels. Third quarter, almost 5%. Fourth quarter, 3.3%. We were an outlier compared to the rest of the world. We're going to slow. Undoubtedly, we're going to slow. But I don't think we fall into recession unless we get some sort of disorderly financial adjustment or the Fed makes another policy mistake. There is inherent strength in this economy, and that inherent strength has carried us through some pretty difficult geopolitical and political circumstances.
What would your idea of a Fed policy mistake be at this point?
Well, before he answers that, I would love a more normalized economy. Listen, I'll tell you what's not normal. You know, the fact that you could try to call landscapers up and, you know, you want to do your lighting for your front yard, and it's hard to even get people to come out to the job site because they're so busy. That's not fun, right? You know, to try to contact pool companies and they don't want to, you know, even contact back because they're so busy building so many pools because there's been so much money in the system, right? That's not fun. And you can go industry by industry, like, you know, I think that because usually people are kind of fighting for your business, right? But I can tell you over the past few years, it really hasn't been like that. A lot of industries have just been in such a position of power that you as a consumer, you kind of look out there and you're like, man, I remember the old days when, you know, which wasn't that long ago, let's just call it prior to Rona, when, you know, there was demand for products, but it wasn't so overwhelming that people were so busy that they took things for granted, right? And I think that's a lot of what we've had over the past few years. So, you know, I don't think that's the worst thing.
So, for example, if they remain too...
Recessions are... I'll explain that in a minute.
That is now the policy mistake, that they are so scared because they were late, because they communicated poorly, because their forecasts were wrong, that they've been so shaken up that they end up staying too tight for too long.
Well, what's too long if you already think a Fed cut is not coming before June?
No, June is fine. But
okay.
If, for example, we're having this conversation in September and they haven't cut yet, then I think that will constitute a policy mistake. Look, I've been with you consistently for at least 6 months saying we're not going to get the sorts of rate cuts that the market had priced in, and we're not going to get it as early as March. June and 3 cuts is much more realistic. Now, if the Fed delays much longer than that and doesn't come through with 3 cuts, then that would be the policy mistake.
So I have a view on recessions. The recessions are really, really good, actually. And the reason I have that viewpoint that recessions are very good is they're so necessary in the system. And the reason they're necessary is recessions give everybody a moment to be very thankful and grateful for, let's say, having a job, for having a business, for being able to make money, those sorts of things, right? When everything's just so good for so long, you start to take a lot of things for granted, right? No different than, have you ever wondered why are we designed as humans to get sick? Have you ever thought about that before? Because we could have been designed to never get sick, right? And just be perfectly healthy all the time. I believe, and also you got to ask yourself, why do we go through tough moments in life, right? And I have asked myself those questions a lot of times in the past. And what I came to the conclusion of, things like getting sick, things like, you know, going through tough things in life and struggles and those sorts of things, they make you appreciate the good times so much better. You ever been super sick, you know, you had the flu super bad or something like that, and you just feel like death. And then, you know, once you get better the next few days, it's just like the sun's hitting you a little different. It's just like, oh my gosh, life is so great now, right? I think that that's a big part of it. And so the recessions are very similar to that. It keeps everybody at bay from getting too overly, you know, optimistic on spending money, taking out loans, those sorts of things, and also brings people back to a grounded reality of, like, you know, it's not always unlimited demand out there, and you know, you gotta appreciate what you do have for a business, for customers, for a job, those sorts of things as well. AI could power the NASDAQ 2 times higher in the next 2 to 3 years, Gene Munster. Okay.
Prompting a sharp drop in tech stocks. Joining us right now with more on the sector is Gene Munster, managing partner at Deepwater Asset Management. Has the calculation or valuation issue changed, given what we're seeing in terms of CPI? And then obviously what I think folks think Jay Powell is actually no longer going to be doing anytime soon.
Andrew, I think it does. I think it pushes back what that inflection point is. I'm a believer that we're going to get to a 3 to 5 year bull market here powered by AI. But investors need to get on the right side in terms of when we're going to see these rates start to go down. Expectations now, I think, are for June. And my sense is it's probably going to be later than that. I think this is just the most sticky part, and I think is a good reminder to inflation does matter in the near term with tech stocks. And Andrew, just to emphasize this point, it may seem subtle to push back a window by 2, 3, 4 months. But if we look back at 2021, different environment, rates were going up at that time. But the Mag 7 was down 32% in the 6 months from October of 21 when those rates started to peak. And then if you look at the emerging tech within the NASDAQ, that was down 70%. And so rates do matter. I think investors are still off sides when it comes to when to expect some of these cuts. It does dampen some of my enthusiasm because, as I mentioned, I'm very bowled up about where this ultimately is going to go. But investors need to right size when these rate cuts are going to happen.
Given what you just suggested, then, what do? You want to own none of this? You just want to wait? When would you be in?
So I think that it is wise to be mostly in now because, again, I think we're going to this 3 to 5 year bull market. We talked about the negative lever related to inflation, but there is a massive positive lever related to AI. And investors have struggled about how to kind of capture and guess what the impact is going to be. And my sense is that you need to put this on a spectrum
It's a good day
of
for the
AI
public
and
cow.
its impact and other paradigm shifts. And I would put the PC at a 20, mobile 25, the internet 50, electricity at 100, a scale 1 to 100. Electricity is at 100. AI is 99. It would be 100 if it not for you need electricity to power AI. So when you have that perspective, when I have that perspective, and I think about what's going on with these interest rates and inflation and where investors are in the near term, I think you can get kind of misled into worrying about what's going to happen over the next 3 to 6 months. And ultimately, if this is as big of a paradigm shift as I think it is, even if it's half as big, I think we could see the NASDAQ move up considerably, 2x in the next 2 to 3 years.
Okay, different question. We were talking earlier about the Instagram post and Facebook post that Zuck put out about the...
That's too bullish. 2x in the next 2 to 3 years in the NASDAQ? Too bullish, Gene Munster. Too dang bullish.
Meta Quest 3 versus Vision Pro. I think for right now, I agree with him. I think I think for the use case, they may be the winner. And for most people who can't really afford $3,500, it's a pretty great product at $500.
Yeah, I don't know if you guys saw, but Zuckerberg did something pretty wild yesterday. Mark Zuckerberg. He posted a video on his Instagram, and it went kind of viral all over the internet, basically laying out the case why he believes Quest is better than Vision Pro, even though it's, as he puts it, 7 times less expensive, right? And so I thought a few things of it. First, that is like an admission of like somebody's taking the spotlight off us and they grabbed it, and so we need to get it back. So it's a little bit of a desperation move there. You don't make that move if you're clear number one, right? So that was kind of the first thought I thought of when that whole news came out, right? And I saw the video. Second component was I thought he made a lot of compelling points in it, a lot of great points, and I thought it was smart because it's going to get the conversation now in a debate about, well, Vision Pro or Quest, which I thought it was a great chess move by Zuckerberg, and I saw the reaction on his Instagram, I saw the reaction on Threads, and it was pretty positive. But those are owned by Meta, so I said, okay, let me see how the reaction is on, let's say, X, where a lot of people hate Zuckerberg because they like Elon Musk, and then Elon Musk and Zuckerberg, blah, blah, blah. So even on there, I would say it was much more positive reaction to his video than I thought it was going to be, just to be quite honest. And so it looks like it was actually a really brilliant move by Zuckerberg to come out and post that video. And, it also goes to show you that's the founder spirit, right? Most of these big tech companies, they don't have that founder spirit anymore outside of really NVIDIA and Tesla. Apple doesn't have that anymore. And Apple's a great company. Microsoft's a great company. They don't have that anymore. Google's a great company. They don't have that anymore. They don't have that founding spirit where, the one who grew this whole thing into be what it is. There's just a different level of care and thought and move fast. And I bet you any money Zuckerberg just thought I'm going to record a video and we're going to do this, right? And that's just so much of a different thought process that you can only get there mentally as a founder of a company. Tim Cook would never do that. Tim Cook's not just going to say, let's go make a video on something. No, no, you don't. You can't, your brain doesn't think like that when you're a big corporate normal executive, right? Satya Nadella is not going to do that. And those are great CEOs. Nothing wrong with Tim Cook or Satya Nadella or Sundar Pichai over there at Google. They just don't think like that. They're not going to move that fast. Jensen, Zuck, Musk, these guys think different. They're the founders, right? Steve Jobs, he obviously would always think different, and he would make different moves than I'm sure Tim Cook would, obviously.
What do you think?
I think at this point, it's a good product at 500. I don't think it's mainstream. They've sold, call it 8 million units before the last 6 years leading up to Quest 3. They've probably done another 1 million units since that's come out. And so I think it's good, but I still don't think it's still such a big gap between what Vision Pro is. And of course, there's a big price gap. It's a 7x price gap there too. I would just sum it up that I don't think it's mainstream yet. I don't think Quest 3 is mainstream. It will be the alternative to Vision Pro. And I will put another stake in the ground here, is that over the next 5 to 10 years, spatial computing, whether you call it spatial computing or the metaverse, is going to be something. Meta's got a lot of work to do to catch up to even get close to where Apple is. I think that they will help close that gap, and I think they will be the spatial computing metaverse device for 80% of the world, and Apple's going to own the 20%.
Wow. Okay, so that means but that would be like being a winner. I mean, a lot of people are.
So my guess is for Quest 4, Meta's next product, I believe Meta's going to load it with tech. But I believe their price point is going to go up to either $799 or $999. I do believe Meta's going to try to keep it under $1,000, so it still looks affordable. Because once you go over that $1,000 price point, people have a lot more trouble justifying it. But I think they could go to that $799 price point, because right now they're at $499 for Quest 3, right? Then go to $799 or $999 and load that thing with tech. So everything is as good as a Vision Pro, if not better. And so that's where I think they're going from here. That's my personal opinion. And it's going to be an interesting fight. The good thing for Apple and Meta is they got the market by themselves. There's no one else really competing here. And if other big dogs do want to get involved in this, it's going to be too late. You got to be in the fight now. The fight is right now. Like this year, next year, this is a fight. And so if you're not in the fight throwing your sword in there right now, you're not going to be in this fight. You'll always be like a very niche company if you ever want to try to compete with Meta or Apple in this space.
Off Meta, and I think I've been saying the whole time is you may think that the Vision Pro device is better, and technically in so many ways it is, but when you add the weight and the cost and all these other things, and then you look at this other product, you say to yourself, okay, maybe at least for now, and it could be like an Android.
I think that's the right analogy. That's exactly how I think about it. This is Apple versus Android. In this case, Meta's going to have control of the 80%. Google, really, Samsung, they're nowhere to be found here. And it is just surprising to me how slow that they have been to move here. So I think that this is an advantage to Meta. As Meta shareholders, I wish they wouldn't be spending $15 billion a year on Reality Labs. I think that they could accomplish what they're doing for half that much. But they are, I think, this is a force of will of Zuckerberg. When Zuckerberg puts his mind to something, so he's going to have a device that's going to be good enough to capture that 80%. And once app developers, of course, start to make progress, I think you're going to see more of this adoption curve. It's going to take years to get there, but it's going to be Apple and Meta when it comes to spatial computing.
Gene, very quickly, I just want to make sure I heard you correctly. What were you saying? You think AI is going to push the NASDAQ to
Thank you, Becky
times
Quick.
the level in the next
Becky
2 to 3
Quick.
years? Or did I mishear that? Because you're thinking NASDAQ 30,000 to 45,000 in the next 2 to 3 years?
I believe we're going into a 3 to 5 year bull market that is going to end with a bubble. The bubble will burst, but I think we're in the front end of that 3 to 5 year bull market. If you look at what the Qs are trading at now, NASDAQ's trading about 28 times. It peaked at 100 times back in 2000. Now, because of the weightings of the mega caps, we're not going to see, a 3x return here. But if I'm right that this is, in fact, much bigger than what the internet is, you can build a case that there will be capital rushing in to enable this AI, and you will see a bubble emerging. And so whether it's a 2x or a 3x, I don't know what it is, but I do know that AI is going to be transformative and power the market higher.
Wow. Big statement by Gene Munster there. Holy smokers, that was no dang joke. By the way, in regards to Meta, they also are selling a lot more of their eyeglass-related product, which I believe is a partnership they have with Ray-Ban, and I believe that product is, that's definitely a cheaper price point product, but that's kind of, the future of eyeglasses, I guess you could say, in the future. And from what I heard, that one's really selling well. So, they have several different products and several different categories they'll be competing in that space over the next 5-10 years. Next one up here, Dan Niles. Talk a little Meta in the markets.
Founder and portfolio manager joins us now. So Dan, let me get it straight. You're long 4 of the Mag 7 and short the other 3. What's the strategy?
Right. Well, I think if you look at the last couple of years, earnings haven't really mattered. You go back 2 years ago, 2022, they all went down pretty hard. The Magnificent Seven were down 46% in 2022. You look at 2023, earnings didn't matter again there, where as a group, they were up 111%, despite the fact that Tesla's earnings for the December quarter came down about 50% over the course of the year. The stock doubled. You look at Apple, similar situation, where earnings for the fourth quarter came down about 10% over the course of last year, and the stock was up 46% or so. So to
be fair, let me stick up for Apple for a moment. They are still growing their earnings per share very nicely. Look at their latest quarter. The results was double-digit EPS growth. That's pretty darn impressive.
Much of a difference. You look at this earnings season so far, and the earnings have actually started to matter. Apple's numbers came down on the top line for the 5th quarter in a row, and the stock actually went down. Tesla, similar situation, where that's down over 20%. Google,
the way Dan Niles is framing it here, he makes it sound like Apple's revenue's literally negative. It's not technically. They actually grew revenue. It was, roughly $2 billion ballpark. But the way Dan Niles is framing some of this makes it sound like, oh my gosh, this company's EPS went negative or, down year over year. It might be a deceleration of growth.
It's more mixed in the sense that their most important businesses, search, YouTube, owned and operated, all 3 of them missed in advertising. And you put that in sharp contrast to a Meta where they crushed their advertising numbers. And so that's why you combine that with, Amazon did great, beat operating profits by 20%. You talked about NVIDIA. Everybody knows the numbers are going up a lot there. And Microsoft did well in Azure. And so that's why we have the fantastic 4 on the long side, and we're short the other 3.
I mean, the 4 that you're long are very consensus, and they've done very well. You had a great call on Meta last year, ran up more than 100%. So now it's up another 32% year to date. NVIDIA's up another 49%. Does it make you nervous that we're sitting on top of these gains in trades that everybody likes?
Not really, because you have to look at valuation, which is something that, very few people.
Okay, so long Meta Amazon. Yeah, that's my number 1 and number 3 biggest position in the public account, right? And then he's got NVIDIA, Microsoft. So then he basically says he's short the other 3. So the other 3 would be Tesla, it would be Apple, and it'd be Google. Okay. I don't like it. Tesla's gotten most of the bad news behind it. My opinion is Tesla margins bottom in this quarter we're in, probably flatline the next quarter, and actually start to pick up in the back half of the year. I would not want to be short Tesla stock into the back half of this year. like I said, I think their margins are going to start to increase in the back half of the year, and that's going to totally change the perspective on Tesla. Wouldn't want to do that anymore. Okay, Tesla was a good, short position. I had puts on it, it printed, that was phenomenal, right? Apple's a cold stock. Like, to bet against that one's really tough. And somehow they always come through and beat numbers. I don't know how they do it, but they do it. So it's a tough one. And I've tried to bet against Apple, and it's brutal. Google, the valuation is so dang compelling on Google. I don't even understand why you'd want to short Google. If anything, I'd be very tempted to go long Google at this point in time. So, I think that's a little wild. But
talk about, they just want to say, oh, I love this because of, big subscriber numbers or whatever. But if you look at a Meta, you're right. The stock tripled last year almost, and it's up again strongly. But it's being driven by earnings. Unlike an Apple or Tesla, Meta's December quarter EPS over the course of last year went up about 90%. So there's a reason the stock tripled, almost tripled. And if you look at this year, it's still trading at a 24 PE. You compare that to the S&P at 21 times, you're not paying much for it. You look 100%. At an NVIDIA, the revenues this year are expected to grow by 70%. I think it's going to be a big beat and a raise yet again.
But here's the problem. Then he's talking about shorting Google. Well, Google's trading at like a 20 forward P with double-digit EPS growth. So Google just doesn't make sense as a short candidate. You need the market to just tank in general to make money on that one, in my opinion. And if the market's going to tank in general, there's a lot of stocks you'll make a lot more money in shorting than Google.
But you're paying 38 times for it. So it's really hard to say you're in an overvaluation for some of these names. And with Amazon, I think you're going to see the GAAP EPS double from 2023 to 2025. So again, driven by earnings. And then Microsoft, obviously, with Copilot and their investment in OpenAI, which produces ChatGPT, seeing a lot of benefits from that. So I think you have to marry the valuation against this, and Apple's the one I always like to bring up because you've had no growth. You can look at what they guided to for the March quarter. It's the same number that they had.
You've been negative on Apple for a long time, Dan, haven't you? I mean, you haven't been a big fan of Apple's for quite some time.
Yeah,
part on that same thesis, hasn't it been, that they have no growth, which is true, but it hasn't stopped the stock from going up?
Yeah, and that'll happen. And so that's why I brought up earlier, David, that, you have last year, earnings didn't matter. The year before that, it didn't matter. But if you look at this year, the stocks have pretty much dispersed based on how the earnings are turning out. So, we all know that earnings short term doesn't drive stocks. It's multiples. And what are they doing? Over the longer term, earnings always matter. And so I think you're starting to see that play out now.
Yeah, so the tough thing to bet against Apple now, right, and I still have some hedges on for Apple that I think expire over the next few months, but the tougher and tougher thing with Apple is I think the next iPhone cycle, that those should get released in September, I think that one's going to be a big one. And why do I say it's going to be a big one? Well, it's going to be a big iPhone. They're going to up the sizing. And if you look at Apple, every time they usually up the sizing, guess what happens? Big super cycle in iPhones. And I think it's going to happen again. And so my opinion is next year, iPhone units will be up substantially versus where they're at this year. So that's where you get another tough position with Apple there, right? It's just like, dang, man, I feel like we had our chance to really get that stock down substantially over this past 6 to 9 months, and it just didn't work out. And now, I feel like we're running out of time because I feel like once that new iPhone is shown off and starts selling, I think it's gonna be a whole different conversation about Apple at that time. And then people are going to start talking about $250 and $300 for Apple. AI isn't a bubble. There's real demand, says Tom Lee. Let's hear what Tom Lee has to say.
Dow's one of the top strategists on the street, FundStrat managing partner, head of research, not the drummer, Tom Lee. Tom, it's great to have you back on. That weighting thing, this is not new necessarily, but it keeps growing. That bowling ball on top of a pencil, as I've called it, continues to get larger and heavier. Is it a reason at all for Tom Lee to be worried?
Brian, it's not. I think one thing the viewers have to keep in mind is the world is short of workers, right? There's a global labor shortage and there's demand for AI and automation. And it's these 7 companies, or the 8 or 9, that are providing these solutions. So their market cap's growing not just because the U.S. economy is growing. They're really solving global problems. So I don't think that is necessarily a bad thing. It's showing you how important technology's become, U.S. tech companies.
Yeah, maybe, and NVIDIA. Okay, I mean, I think now we're contractually obligated to mention NVIDIA at least 4 times an hour. I'm kidding. Sort of, Tom. NVIDIA, basically the same size now as Amazon. It's part of that group that we talk about so much. Is it a mania? Is it deserved? You just mentioned AI, but I mean, we've gone from $150 to $700 in less than 2 years.
I mean, it's pretty astounding to see the ascent, but we also know in the last 2 years there's been a lot of transformation, and I think really critical mass reached for AI. So to us, it doesn't seem like a bubble. There's real demand there. We're going to find out next week, obviously. But if there is a shortage of workers, we know that over time we have to replace salaried workers with silicon, and that could be several trillion a year of demand. So I think it's too early to say it's a bubble.
How big?
This is a problem. This is the problem. Big problem. Everybody gets so caught up into the stock price is up this much. Stock price is up this much. It's irrelevant. It's irrelevant. All that matters is the numbers, the valuation. Where's the forward P at? Where are the revenue growth rates at? Where's the earnings per share growth rates at? What is expected next year? What's expected the year after? It's all that matters in the end. Whether the stock's up 1,000,000%, 5%, 10%, it's all irrelevant. It just matters where the stock's at now versus those future growth rates and the valuation, okay? And so when it comes to an NVIDIA, if their demand keeps pulling in super strong for this next few years, the stock is undervalued today at $700+. If their demand completely wanes and next thing you know, they have no growth, okay, then the stock's too highly valued. But outside of that, the stock's actually going to $1,000 to $1,500. So, yeah, man, they get so caught up in that. I mean, we could also go back in time and talk about when NVIDIA fell 70% a couple of years ago, right? And when it went from $350 down to a little over 100, we could talk about that as well. But it's irrelevant. It's irrelevant. Numbers and valuations, all that matters.
Deal, if at all, maybe it's not. Is tomorrow's consumer inflation data at 8:30 in the morning?
Well, it's very important because we know the Fed has only 2 inflation reports before the March meeting. It's this report and the one next month. And so I think, the bond market's certainly going to react. I do think the bond market's been anticipating kind of a hot CPI reading tomorrow. So I think if it's a worse than expected report, I think the stock market could be nervous short term. But, given how sentiment is and flows have been finally turning positive for stocks, I think it would be short-lived weakness.
Yeah, pretty amazing. You're not expecting a March cut, though, are you, Tom? It's May.
He was right. It was short-lived weakness because now we're all of a sudden, right bouncing back the very next day. He was right.
That's right. I'd say the market's been pushing out the timing of cuts towards May. I think one of the sort of sticky points in the CPI report has been auto insurance. And as that lingers, that makes the Fed nervous about, whether or not we're getting towards 2%. But I do think the odds of a March cut are better than the 15% that are priced into the futures markets.
Tom, I want to switch gears to Bitcoin. It's been a big couple of days, really, for Bitcoin. I'm sure you watched the Super Bowl last night.
Okay. Yeah, we don't really care about that. All right, you folks want to follow me? X. Pin comment down there. Thanks for joining me as always. Thanks for being subscribed, folks. Much love and have a great day.